Several things that are important are obviously things that could be done within a trading firm or trading participant. And some things are really better placed at the DCM or the exchange. And then other things are at the FCM level. So really when we talk about pre-trade risk controls and risk issues, it's often very important to know where those are going to be placed. And that's something that we took great care in thinking about, because you want to make sure that participants have a level playing field. That a particular risk check or control, if it's placed at the exchange, it affects everybody equally, and that maintains that level playing field that we really think is important to the good functioning of our futures markets. We looked at a number of different controls that can be placed in different places. So let's talk about some of the ones that are clearly a trading participant should incorporate in their activities. Quantity limits. There's no reason why an order should not have some sort of limited quantity, or at least a double check if it exceeds a quantity before it ever leaves the trading participant. But there's also quantity limits that can also be at the exchange. There's no reason why the exchange should accept an order that's above a preset quantity that the FCM or the trading participant sets either. And so there's good places to put those, sometimes in multiple places. We talked about message throttles, and those are important to incorporate as well. You don't want too many cancellations versus orders. However, there's always exceptions. Sometimes the market is moving because there's a related exchange or a related marketplace, an asset that's not a future that's moving dramatically. Well, what's going to happen is your prices are going to update in the futures market also, and there may not be transactions to kind of keep that ratio in balance. But nonetheless, you kind of want guidelines. One of the things that's really coming online and a lot of firms are doing is the drop copy reconciliation. So it's getting basically a second data set to compare your activities to. And you can look at it as checks and balances, you can look at it in a number of ways, but if you get basically what the exchange knows that you did compared to what you think you did, and you can reconcile that in near real time, then you can find problems much, much quicker. I think what's important from the regulatory point of view is not necessarily what methodology someone's using, but that they're using a methodology they can describe, and that methodology actually is producing quality software. There's a lot that goes into software development, and there's no one way or right way or a prescribed way for people to develop software. But there are some good, important practices. Right? You want to be able to move forward with your software development, but also to move back if you need to. You want to be able to know, what went into that software. And so I think that there's important suggestions that we made in our guidelines for regulators to think about and to incorporate if they do advocate something in that area. I think that it's important for them to understand how software is being developed and all their market participants. We want to get all the market participants and regulators on the same page. We wanted to have basically a common nomenclature and an understanding of what people are actually doing and how they're employing these different methods of pre-trade risk or post-trade risk or software development practices. We wanted to have a really common understanding and shared nomenclature so that we can continue this discussion. One of the things that we really wanted to accomplish with the guidelines was kind of, really, take a step back at a high level and make sure everybody understands what these things are and how they're being used currently.